All right, this is also another example of a calculation for the capital budgeting tools. Here we have John's Landscaping Service, which is seasonal. They do business up in the upper Midwest, and he makes good money from April through October while it's still warm. He has he earned six figures last year. None of them were ones and none of them were zeros. He has about 20 employees. He does business to business stuff, so he's not going and mowing people's lawns. He's actually working like with golf courses and crap like that. So he's making good money on this business, but it's highly seasonal. So everything's going good while the sun's out from April through October, but when it clouds up and gets cold, business slacks off. Now, a lot of businesses go out there and try and figure a way to adjust their business so that they are fully employed year-round. It makes it easier to keep your employees happy and working. That's outside the scope of what we're doing here. We're just doing capital budgeting tools. But this is actually a common problem businesses run into, and so they might want to add a second business or something to diversify themselves. So he's decided on snowplowing. And he's not talking about snowplowing people's driveways. He's talking about snowplowing businesses, such as there's some local commuter airports. He would be the guy that would clear their airstrips and taxiways. Or he would have some local business complex or a strip mall that he would be the clearer of, or other things with private firms in the area. So to do that, we're not talking about two monkeys in a truck. We're talking about real snowplow trucks, and his small fleet of heavy-duty snowplows would cost $150,000. All right, and he'll use straight-line depreciation for simplicity for the problem. And he'll also have to spend $30,000 up front to set up an office to handle advertising and storage and store spare parts and salt and other junk like that he doesn't need in the current business that he's in. All right, so it's going to be $180,000 to get him into this business. All right, he's going to do it for 5 years, and there's some projections over revenue and expenses shown below. Now, where they come from, John and/or his business analysts go in, open up a spreadsheet and start comparing other businesses and doing forecasting and all that other junk. We're just taking the numbers that they gave us at face value so we can apply these tools. He's going to work for 5 years, and then he's going to sell the business lock, stock, and barrel. And his accountants tell him that while he could get 4 times revenue for the business, small business often sold as multiples of revenue, he's going to owe some income taxes of 30% on that sale price. So taxes are a big deal, and we actually have to factor those in because they're cash flows. And capital budgeting, the idea is to render everything down into when do the dollar bills change hands, and then to calculate the investment value based on cash flows. So we have some numbers below, but we also have to talk about his cost of capital. The banker says, I'll lend you $100,000 up to $100,000, but you're going to have to give me your personal guarantee, and you're going to have to use the equipment as collateral. That ain't enough, and he needs $180,000, but his sister says, hey, I got some money, I'll invest it as long as I get a return of 12%. So what he will do is go to the cheapest source of capital first, which would be the bank loan at 7%. His sister's investment is an equity investment. She wants a cut of the profits or what have you. All right, so his tax rate's 40%, so the 7% he pays to the banker would only be 4.2% after tax, because since interest payments are tax deductible, he'd actually be paying 7% times 1 minus his tax rate. So he'd only be paying 60% of the interest. The other 40% is paid by Uncle Sam. So doing the math, his weighted average cost of capital from this, the $100,000 he gets from the banker costs him 4.2%, and the $80,000 from his sister at 12%, comes out to right at 7.67%. Okay, so there's his weighted average cost of capital. Now he's got to see how much money this thing's going to make him. All right, the snowplow costs $150,000. The supplies $30,000. He's forecast revenue, cost of revenue, gross profit, indirect costs, the depreciation expenses on the snowplow, and he's just depreciating it from $150,000 down to zero over the 5-year period. So that's $30,000 a year, which gives him a negative operating profit. Oh my goodness, that's terrible, isn't it? Except that the operating loss from this business would offset operating profits from his lawn business. So instead of having to pay income taxes on profit here, he'd actually be sheltering profits he's earning on his other business, which would reduce his tax bill by these amounts. That's why they're showing as a negative, which would mean his after-tax operating profit from the snowplow, the actual operating profit minus a minus tax, it's still negative. Oh, woe is me. Well, remember, a chunk of that is snowplow depreciation. That's a non-cash expense. He builds up this business and then sells it at 4 times revenue in the future for $320,000. The accountant estimates you're only going to get to keep 70% of that. Okay, but that's $224,000. So if we go out here and look at cash flows, he has to spend $180,000 at time 0. We'll put the times on each of these. Time 0, that's the cost of the snowplow and the equipment to get the everything up and running. And then his after-tax operating profit is $16,200 in this first year. And you can get that by simply taking the after-tax operating profit and adding back depreciation expenses. Okay? So that's why those are positive. He actually brings in positive dollar bills in each of these years. And we call operating profit earnings before interest and taxes, or EBIT, and that's why you see the reference over there. But you'll get more of that as you study accounting. And then his terminal cash flow would be this $224,000 that he gets at the end of the year. So these are the total cash flows for this business. $180,000 up front, then $16,200 in year 1, $19,800 in year 2 and 3. Year 4 is $18,600, and year 5 is $241,400. The present value at 7.67%, that's not actually 8%, it's 7.67%. We use the NPV function, 7.67%. The present value of the cash flows in years 1 through 5 is $228,685. So the total cash flow in the future is $315,000. So the total future cash flow is $315,000, but on a present value basis, that's actually $228,000. Subtract from that the initial investment, the net present value, the NPV on this, is $48,685. So it actually still making money. The IRR is 13.9%. The modified IRR is a little under 13%. And those are both higher than the weighted average cost of capital. So he's going to borrow at 7.67% and invest at something that's earning 13.89%. That means that he's actually making money. Anytime the IRR is higher than the cost of capital, you will have a positive net present value. So that's just by definition, that's how the math works out on this thing. Anytime the IRR is higher than the weighted average cost of capital, it will be a positive net present value. The profitability index measures how many dollars are coming in per dollar going out. So 228,685 divided by 180,000 means that for every dollar you invest, you're making $1.27 in present value terms. That's you're gaining $1.27 for every dollar of the investment. So it's actually a pretty good deal for John and his snowplow business. And let me re-emphasize what the importance of this tax shield up here. Remember, this thing isn't making any money on an accounting basis. All right, so the after-tax operating profit is still negative in each of these years. Where it makes the money is when he sells the business in the future. That's a big capital gain, and that's why he's going to have a capital gain tax on it. But it's also offsetting income that would otherwise be taxed in his other landscaping business. So the tax shield is fairly important. We sort of saw some of this when we were looking at Amazon. Amazon has low accounting profit, but oh my God, they make a lot of cash flow, and it is reflected in the value of the firm. So when we're valuing stuff, we don't focus so much on accounting profits as we do on dollar bill profits. And that's why you study accounting and finance, is that finance looks at the cash flows as opposed to the accounting profits. That's especially true in small business because most small businesses try and show zero or negative taxable income. Or why pay income taxes if you don't have to? All right, but you study more of that as you go through other parts of the MBA program. In the final analysis, this is a really good idea for John and his company.